shift gears a little bit now towards practical, year-end tax planning strategies for the audience. Joe, maybe we could kick it off with you. Let's really roll up our sleeves and get very practical. We're sitting at December 11th today. What are some things that people should be thinking about over the next 2 weeks?
Yeah, when we get to this point in the year, there's really a number of considerations we want to keep in mind. Again, given we're quickly approaching year end, especially for those high income earners with more levers, more opportunities to take advantage of certain, unique situations here. So things like making sure we're fully optimizing those tax advantaged retirement savings accounts. Think your 401ks, 403bs, IRAs, HSAs, and whatnot. The other is optimizing those deductions, charitable giving strategies before year end, really take advantage of some of the unique capabilities here. And lastly, let's evaluate some of our timing strategies around income and deductions, whether there's a deferral, whether there's a loss realization and whatnot.
Awesome. There's a lot to unpack in that, so maybe we'll go a bit deeper and do some quick hitters on each of those themes that you hit on. To start off, Joe, for audience members that are living in high tax states, did anything change this year around state and local taxes? And are there any practical steps that our listeners can take to be better positioned?
Yeah, the big one here being the previous cap on state and local tax deductions was adjusted up from $10,000 to $40,000 for those realistically making under $500,000. AGI limitations there through tax year 2029. What this means is there's more opportunities to take advantage, potentially reduce taxable income by prepaying any state local tax obligations we might expect to be due in early 2026. So think your property taxes, any estimated tax payments that we think are going to be due at the state level. Pull those forward and really upsize those itemized deductions to the state and local tax deduction.
Got it. And let's say there's another archetype here. Imagine you're an executive with high compensation. Walk me through how we think about capital gains and equity comp and what are some of the strategies that they can consider?
Yeah, for executives with equity comp, it really creates unique tax challenges that we need to plan through. Some of the key strategies around here are, one, first and foremost, let's know the equity type. How is that taxed? How is it vested? What does this look like? And how can we plan around that? Then we want to take that and time our sales for tax efficiency, looking at things like long-term capital gains or selling directly after vest if we need liquidity and whatnot. Diversifying without triggering capital gains. So really looking at the idea that is there an exchange fund? Is there another opportunity to diversify here? Round that out with leveraging charitable giving. Again, equity comp, we have highly appreciated assets. Let's look at opportunities to reduce capital gain exposure through charitable giving. And lastly, really evaluate year-end tax loss harvesting. Is there any down positions that we can utilize in this year to offset earlier gains or higher income years? The last part that hits on a lot of higher income earners is the idea of year-end bonuses. Really, if we're in a high income year, consider that idea of delaying until early 2026 or defer that income recognition under a non-qualified deferred comp plan if eligible to further avoid increasing taxable income in 2025.
So the name of the game is really minimizing the taxable income in the current calendar year, given there's not much time left. Um, Good one. So you had covered tax advantaged accounts before as well in the overview. Can you walk us through, retirement account strategies in more depth as well that folks can take before year end?
Yeah, absolutely. So you have two main vehicles here. One being the traditional accounts, which reduce our taxable income in this year. We defer all of that tax liability, the recognition of income as ordinary income down the road until we start pulling from it in retirement years. And you have the other side of it where you have Roth accounts. You pay the tax now, but all that appreciation grows tax-free. Further flexibility is we're not introducing the idea of RMDs and whatnot. So a couple ways to think about it is if your income's lower in the current year, say there was an unemployment change in job situation, we're close to retirement years, we took some time off. Or you anticipate higher future tax rates. And lastly, if you want to reduce future RMDs that we just talked about, consider the idea of converting those pre-tax dollars in a traditional account to a Roth. If you're on the flip side a high earner and we're outside of certain thresholds for deductible traditional accounts and whatnot, consider taking advantage of the ideas of backdoor, mega backdoor Roths for that long-term tax efficiency, really upsizing those advantages there. Lastly, as we think about some of our, investors who are close or already at RMD age, really make sure we're taking RMDs to avoid any kind of penalties once we hit 73. If you're close to it, let's go back to that Roth idea and really evaluate, does it make sense to start converting now?
Got it. Thank you for that. You'd covered deductions a little bit in detail before, but maybe let's go dive a bit deeper there as well. What charitable giving opportunities exist and work well for high income earners that they could do before year end?
Yes, there's some changes to charitable deductions following One Big Beautiful Bill Act, and itemized deductions as well in 2026 that make giving strategies slightly less advantageous moving forward. So really, the name of the game is efficiency matters here. I'd first off consider things like charitable bunching, which is the idea of consolidating several years of donations into one year, doing it in a lump sum, either outright or through a donor advised fund structure, especially if we think 2025 is a high income year and or we're already utilizing, itemized deductions given that elevation in standard deductions currently. I'd also want to be strategic about what I donate. We touched on the idea briefly earlier of donating highly appreciated securities versus cash is one advantageous because we're not recognizing capital gains if we were otherwise to sell, but also we're receiving a step up to fair market value on those shares that we contribute. So really upsizing our deduction and our charitable impact. Lastly, again, I think we bring it home with the idea of RMDs and is there a way to think through, not upsizing taxable income to the idea of qualified charitable distribution. So for the idea of those that are 70 and a half and older, the QCD's qualified charitable distributions really allow those individuals to support charitable causes by taking part of that required RMD, so satisfying RMD requirements up to thresholds, it's $108,000 in 2025. But we're also not increasing taxable income. So we're satisfying that RMD while supporting charitable cause, really putting us in an advantageous tax position as we round out the year.
And last question on gifting, Joe. With estate exemptions set to increase in 26, anything that clients should consider doing now or next year on the tax efficient giving side of things?
Yeah, it's a great one to think through as we think about not just taxes today, but over the life. Again, taxes touch everything we do from our legacy to how we earn and kind of the lifetime strategies from there. With the passage of One Big Beautiful Bill, the use it or lose it urgency goes away. The temporary higher estate tax exemption, which was supposed to sunset at the end of this year, really becomes, quote unquote, permanent up to $15 million per individual, $30 million for a married couple moving forward. So starting in January 26. What this does is gives us much more opportunity to be thoughtful around gifting strategies to better align with our holistic overall wealth transfer and tax optimization financial goals from there, rather than just simply gifting before year end aggressively to avoid those federal estate taxes. The one caveat here, though, is many states have their own set of estate or inheritance taxes, often with much lower exemptions, some as low as $1 million as compared to the federal exemption. So we still want to be mindful and proactive with our planning. Some lower hanging fruit, things like lifetime gifts, including those that utilize the annual gift tax exclusion, which is $19,000 per individual, $38,000 per couple, often avoid state level transfer taxes, which is a really smart move to start moving money outside of the estate now, even if the federal urgency feels lower following recent legislation changes.
Awesome. Lots of practical advice there across many, many different categories. Mike, maybe we'll have a question for you to round us out on taxes. What in the One Big Beautiful Bill Act this year were the biggest changes, and what was your single favorite?
It's a great question. I think the biggest one was likely the reinstatement of bonus depreciation. You look at the corporate jet market and it's never been hotter for that exact reason. But for investors, this means if we can find real assets and triple net leases are an example, real estate assets are an example, a lot of infrastructure assets are an example. We're able to take upfront depreciation often in excess of our investment. And it's a pretty remarkable tax benefit. And I pair that with another area that got renewed in the bill which is opportunity zones. And if you do have capital gains, through an opportunity zone, you can defer it between 1 and 5 to 10 years, depending on the period. They actually really enhanced opportunity zones, so you can defer that gain. You can take the depreciation, and then you actually, upon sale of those assets, assuming that you hold it for the 10-year period, you're not paying any capital gains on the gain, nor do you have any depreciation recapture on exit. So I like it because I think it combines a lot of the best elements. And certainly for our folks that are business owners or small business or technology investors, the qualified small business stock reinstatement with actually enhanced exemptions, between the first 10 million plus or 10 times of investment being completely shielded from capital gains is very significant. And I think we've gotten more sophisticated in the strategies around that, stacking strategies, trust strategies, ways to really multiply the ability to use the